Okay, there we go. All right. So I'm going to really try to quickly go through this so that I can get you um, back to your studies and get that trigger clicked on for your appeal. But I just want to talk about business organizations. I know last week I talked a little bit about UCC. So this is, UCC kind of runs into business organizations as a whole, and not necessarily how we do contracts, but business organizations and how they're structured. So a business, which is a legally recognized organization, is designed to provide goods and services to consumers. And that's where the UCC and the contracts come into place. And, most businesses are privately owned and formed to earn a profit. And we're going to talk a little bit about public companies tonight, because that's, there'll be a few questions on the exam, next week's exam, I believe, and could have been this week. I'd have to get in and look at it. So one of the main objectives is a receipt or generation of financial return in exchange for work. And there's different types of other enterprises, such as state-owned enterprises, where profits are not, that's not the goal. In some state-owned, not-for-profit, it's just really about recovery. So if we have expenditures, we just need to meet the recovery of those expenditures. Where in a business, private business, everything is really based upon the financial return. So there's basic forms of ownership. And the common ones are sole proprietorship, partnership, corporation, and a co-op. And there's a few others, and I'll cover those. So sole proprietorship, the key thing here is you are the sole owner. All profits and all losses accrue to you, the owner, and they're subject to taxation. And if you have any questions as we're going through here, don't hesitate to ask.
Okay.
So all the assets, so anything that the business owns is owned by the proprietor. And one thing that I commonly find sole proprietors doing is merging their personal, like a checking account, with their business checking account. And you have to stop and think about this, because you would say, well, how can you value the company? So if you ever wanted to sell your company, how are you going to value it if you have your personal and your business expenses merged together? So even though it's a sole proprietorship and there's really no legal distinction between the owner and the business, you still have to have a way to gauge the performance of the company. Does that make sense?
Yes.
Yeah, so you want to keep those two things separate. You want to keep your personal assets and business assets, personal expenses and business expenses, very separate. Okay, so
I think they're gonna help in another way. For example, if something happened to the business and then they're gonna get the asset of the business, if you have your asset and the business asset all together, then you will lose everything.
Right. Yeah, absolutely. That is, and that's one of the liabilities of that. So in here, the owner has unlimited liability. The owner has no partners, and but it also makes, there's a huge liability there. Anybody can go after everything. They can conduct business with a trade name or just your own legal name, like Marie. And it also allows a proprietor to open up a business account with banking institutions. So then you have a partnership, and there's different types of partnerships. They are favored over corporations for taxation purposes. And that's really what drives the structure of a business entity, is really how it's taxed. And again, if you have partners or not, that plays a big part in it too. But here, a partnership, the two partners, the owners, however many partners there are, they share with each other the profit and losses of the business. The structure does not generally incur a tax on profits before it's distributed to the owners. So there's no dividend tax levy. However, depending on the partnership and the jurisdiction in which it operates, the owners of a partnership may be exposed to greater personal liability than they would as a shareholder of a corporation. So corporation, oh, I think I need to, I was like hustling to get this done. And I'm not going to include this. I don't need to. This was more on a global level. So a corporation is a legal entity separate from the shareholders and the employees, completely separate. In an American and increasingly international usage, the term denotes a body corporate formed to conduct business. So it is a total different entity. It's an entity unto itself. Oh, I don't know why my stuff got so big here. So they exist as a product of corporate law, and their rules balance the interests of the management who operate the corporation. Creditors who want its goods, services, or money. Shareholders are typically in the secondary market who hold shares related to the original investment. And this doesn't necessarily mean that they have to be, this has to be a public company in order to have shares. You can have a private company and have shareholders. So let's say you had a bakery and you created a corporation, you could have some shareholders that are part of your corporation of the bakery. It doesn't need to be a public company. But everybody that works together in that corporation, they are going to produce value and generate income. You know, people rely on corporations for many things, not only their goods and services, but for employment, the value of pensions, economic growth, and cultural development. So they're truly a huge part of our economic life. So have you ever heard of a co-op before? Do you know what a co-op is?
No, not really.
So a co-op is generally a group of individuals that come together and form an organization for a mutual benefit. A good example is in Idaho Falls. They have a potato growers, and this is common in agriculture. So they have a potato company, and a bunch of the potato growers got together and formed a corporation, a co-op, where they contract to sell their potatoes to them, and from those potatoes they make a product that they sell to the community, the public. And
so it's a short name for cooperative?
It's a what?
It is a short name for cooperative?
A short name, no, it's just a type of formation, a co-op. You could have all different types of companies that could be a co-op, but traditionally there's some form of an entity that has a mutual benefit. So like you could have a strawberry grower. So down in California, they have a lot of strawberry growers who have come together to sell their product. They buy their product from themselves, but then they also come together to sell the product, and the entity that sells the product is managed by a board so that they don't get in trouble for like price fixing and things like that. Okay, but it's a business owned and controlled you know, by the people who use its services or work at it. Okay, but on its face, it's a business and functions as a business. It contracts for goods and services. It's held responsible for taxes and to operate ethically and legally. So, you know, it can't operate outside the boundaries of a corporation, but it is typically a corporation or a limited liability company. So the other types that we have are franchising, joint ventures, and holding companies. And a holding company is a company that just owns other companies' outstanding stock. It doesn't do anything other than allow for the reduction of risk for the owners, and it allows the ownership to control the companies. But its only purpose is owning shares of other companies. It doesn't get involved in the management of the company. So you might hear that term here and there. Franchising, are you familiar with a franchise?
Yes.
Okay, so like McDonald's, they have a lot of franchises. They have corporate stores and they have franchises. So that's a pretty self-explanatory.
Yes.
Franchising is fairly popular because, you know, it consolidates marketing and the clout for purchasing power, and is really a, you know, very successful type of ownership. But typically the people that are the franchisees certainly have to pay a lot of royalties to the owner of the franchise. So like most of your fast food chains are all franchises. So, it's, you know, like I said, franchises have been around for a long time and have done very, very well, especially when, you know, the interstate highway system really helped propel transportation along. It just really, fast food establishments just went crazy. Joint venture is an entity formed between two or more parties to undertake economic activity together. And so they create an entity, and it can be for one specific project, or, you know, or a number of them, but they share in the revenue, expenses, and control of the enterprise. This is not the same as a strategic alliance, which involves no equity stake by the participants, and it's a much less rigid arrangement. Now, I just put this in here because I've had a couple of students ask what's the difference. So it's really the purpose of the entity, not the type of entity. And a joint venture can be a corporation, LLC, partnership, where a strategic alliance is not. There's no equity stake by the participants. So reasons for forming a joint venture is, there's a lot of good reasons. It builds on company strengths, it spreads costs and risks, it improves access to financial resources, economies of scale, size, access to newer technologies, customers, and innovative managerial practices. I'm not going to cover all of these, but it certainly plays into all of these with a joint venture, and they're very popular when you can get a good partnership, because it is a type of a partnership. So you have the diversification, the synergies, which are really key to a joint venture. And again, I'm not going to cover a lot of this because this isn't on the test, any of the tests, but there were just some pieces of information that, you know, I wanted you to have from this presentation. Just good reference. So when you create an organization, it can be by function, and I'm going to run through these pretty quickly. So this is a pretty common organizational structure in a business entity, and it's usually by function, okay? It's very efficient. The employees get experienced in and competent at a particular job, and accountability is very clear. So these are some of the key reasons why they do it by function. The other one is really organization by product, and this is not unusual, but it's a little bit more challenging to do it by product than by function. And it really puts focus on an individual product, which can be a lot more costly because you might have to add more labor to help run those different areas of the products. And you can tell this was an international presentation I was doing. But each group can be run as a separate profit center, but sometimes it does add a little bit more labor costs. And then by customer or customer type. And this is not unusual in a large organization that you've got not only manufacturing, but retailers, and like Walmart probably does it like this. It has different types of organization structures that are similar to this right here. It definitely promotes the focus on the customers and their individual needs, but it can be a lot more complex and difficult. This is probably a key issue, that the customer groups can be small and individual departments can be inefficient. That's why this is not necessarily the most advantageous. And then again, there's duplication of resources. Like you'd have multiple accounting teams, multiple HR teams, and the management control can be very non-centralized. So overall, all these structures have strengths and weaknesses. So a business has to think not only about the structure that they have, but the organizational structure. And when we have to restructure, it's extremely expensive and disruptive. So it's better to get it right the very first time. Focus is really important. And you know, when you look at the focus of the organization, that helps you create the organizational structure. So I want to talk about public companies, and these are the last couple pieces of my slides, because we're going to step into directors' responsibilities in our next office hour next week.
Okay.
So the public company can be defined in a number of ways. First, the company's securities trade on a public market, and second, the company discloses certain business and financial information regularly to the public. So in general, we use the term to refer to a company that has a public reporting obligation. The companies are subject to public reporting requirements if they, as I said, sell securities, such as an IPO or just in a regular public offering. They allow their investor base to reach a certain size, which triggers public reporting obligations, or they voluntarily register with the SEC. So those three things can subject to public reporting requirements. So a private company can also become subject to public reporting requirements by merging with a public shell company. And this process is called a reverse merger. And with any investment, the investors should proceed with caution whether to invest in reverse merger companies, because you lose control. So the SEC views companies as public if they are subject to public reporting obligations. So remember that. The key here is if they're subject to public reporting, okay? There are certain instances, however, where the securities of a company that does not regularly report business and financial information to the public are nonetheless traded on smaller public markets. And investing in those companies can be riskier because there's very little public information to allow investors to make an informed investment decision. So this last sentence gives you kind of some insight as to why when you have a public company, what do you have? You have investors, right?
Yes.
So that's why you have to have these transparent public pieces of information. Those investors have to be able to make informed decisions. And if they don't have information accessible to them, which if you're a public company, you have to disclose everything practically. So that's why they do it. Okay.
Okay.
So the public company's disclosure obligation begins with the initial registration statement that it files with the SEC. But the requirements don't end there. They have to continue, and it's constant. They have to keep their shareholders informed. And shareholders, remember, if you've got a public company, it's not just the 5 or 6 shareholders. You could have hundreds and thousands. So they have to be informed on a regular basis, and they do this by the company has to file periodic reports and other materials with the SEC. And then the SEC, do you know what the SEC means?
No.
So that's the Security Exchange. So the Security Exchange Commission makes these documents publicly available without charge on its EDGAR website. And the filed documents are subject to review by SEC staff for compliance with federal securities laws. So they're scrutinized. And if the company doesn't meet certain benchmarks of information, then they put the company at risk. So there's some reports that have to be filed by US-based public companies, and foreign companies that file reports with the SEC, they might file different types of reports, but what we see here. So you probably heard about 10K, right? Have you heard about a 10K report?
Yes.
Okay, so this report just includes the company's audited annual financial statements and a discussion of the company's business results. So the auditor who's auditing the financial statements has to give some sort of a notation at the end of the report with anything abnormal that he might look at. He has got to disclose that information in his findings. And so I would pull up these, reference these things that are underlined, How to Read a 10K and Beginner's Guide to Financial Statements. They're really good. Just Google them, and they're good articles to read. So they have the annual report on the 10K, and then they have quarterly reports on a Form 10Q. And they have to file this report for each of the first 3 quarters of their fiscal year. And at the end of the 4th quarter, the public companies file an annual report. But the quarterly report includes the unaudited financial statements and information about the business and results for the previous 3 months and year to date. And then the annual will have the audited results. So they have to come in and get somebody to say, yes, in fact, this is what went on. And then they have the current reports on the Form 8K. And this is to announce major events that shareholders should know about. So like a bankruptcy proceeding, corporate leadership, and preliminary earnings. So this is another good one to read about. Proxy statements, shareholder voting. We talk about this in your text, and I believe there's some questions on that. So they can elect members of the board of the directors, cast votes on executive compensation. Remember, this is a public company. It doesn't mean that the general public can get out here and vote on this, but the public of the business. Does that make sense?
Yes. Yes.
And then the proxy statements, they're going to describe the matters to be voted on and disclose that information. And then there's any other additional disclosures that they would want to share with the company, which would be mergers, acquisitions, offers, transactions by company insiders, and beneficial ownership. That's when a group or person reaches or exceeds 5% of the company's outstanding shares. So they're going to look at that and say, okay. And they want to know why, and there better be good reasons for it too. Well, that is all I have tonight, Marie. Is there anything I can answer for you?
No, not at this point.
Okay. Well, I will post this. I'll also post the PowerPoint, so you've got it.
Okay.
And then post the HOA. And I appreciate you joining me tonight. Thank you.
Thank you so much. Are you gonna go ahead and work on that exempting? I would love to.
Yes,
this.
I will do that as soon as I get off here.
Oh, thank you so much.
Oh,
Thank
my
you.
pleasure. Thanks, Marie. Have a good week.
You too. Bye-bye.
Bye.